Most homeowners in the UK have absolutely no idea that they could be sitting on a tax time bomb right now. And the really scary part is, it doesn't matter if you sold your house years ago. It doesn't matter if you genuinely thought you owed nothing. And it definitely doesn't matter if nobody told you about it. HMRC will still come knocking. And when they do, they bring penalties, they bring interest charges stacking up by the day, and in some cases they bring investigations that can turn your life upside down for months. Today we are breaking down exactly what this rule is, why it's catching so many ordinary homeowners completely off guard, and most importantly, what you need to know right now to protect yourself from getting hit. Let's start with some numbers that should genuinely alarm you. In the tax year 2024 to 2025, HMRC issued 350 failure to notify penalties specifically for capital gains tax. That sounds small, right? It's not. 2 years ago, in 2022 to 2023, that number was just 165. So it has more than doubled in the space of 2 years. And here's the kicker. Tax analysts who looked at these numbers through a Freedom of Information request said the real figure is probably way higher than that. They called it the tip of the iceberg. Because HMRC is not just increasing how many people it targets, it's changing who it targets. And there is a very strong chance that person is you or someone you know. So what exactly is going on? Let's get into it. When you sell a residential property in the UK and you make a profit on it, that profit is called a capital gain. And capital gains tax is what HMRC charges you on that profit. Now, a lot of homeowners assume that because their home is their main home, they're completely protected. And to be fair, in many cases that's true. There's a relief called private residence relief, which means that if you've always lived in the property as your only or main home, you generally don't owe any capital gains tax when you sell it. Brilliant, right? But here's where it gets complicated, and here's where thousands of people every single year get it wrong. The moment your property has not been purely your main home for the entire time you've owned it, you potentially owe capital gains tax on a portion of that profit. And we are talking about situations that are incredibly common, incredibly normal. Situations that people don't even register as a tax event. Think about this. You bought a house 5 years ago. You lived in it. Then you moved in with a partner and rented it out for a couple of years before eventually selling it. You might owe capital gains tax on the portion of time it was rented out. Think about this. You inherited a property. You held on to it for a while, then sold it. You almost certainly owe capital gains tax because it was never your main home. Or what about this one? You moved out of your home 9 months before you actually completed the sale. You already bought somewhere new. You were just waiting for the paperwork and the buyers to get sorted. You might think that's fine. And actually, in that specific scenario, HMRC does give you a 9-month window at the end of your ownership, which they treat as if you were still living there. But the second you go past that 9 months without completing the sale, you're potentially in chargeable territory for those extra months. And this is where the rule that HMRC does not shout about from the rooftops comes in. Since October 2021, if you sell a residential property in the UK and capital gains tax is owed on that sale, you have 60 days from the date of completion to report it to HMRC and pay the tax. 60 days, not at the end of the tax year. Not when you fill in your self-assessment return in January. 60 days from the moment the sale completes. This is a completely separate thing from your normal tax return. It's done through a different system. You need to set up something called a property account through the government gateway, calculate your gain, submit the return, and pay whatever you owe. All within 60 days. Now, you might be sitting there thinking, well, I never sold a property and missed that deadline, so I'm fine. But let's slow down. Because the way penalties work here and the way interest works is genuinely shocking when you see the numbers laid out. If you miss that 60-day deadline by even 1 day, you get an immediate £100 penalty. Straight away. No grace period. £100 just for being late. Now that might not sound catastrophic, but this is where it starts to snowball. If you are more than 6 months late, meaning you haven't filed at all within about 6 months of the completion of your sale, HMRC then hits you with a second penalty. And this second penalty is the greater of either 5% of the capital gains tax you owe or £300. So if you owe, say, £10,000 in capital gains tax on a property sale, that 5% penalty alone is £500 on top of the original £100 fine. Already £600 in penalties just for being late. And then it gets worse. If you're more than 12 months late, meaning a full year has gone by and you still haven't filed, you get that exact same penalty again. Another 5% of the tax owed or £300, whichever is bigger. So now we're at £700 in penalties on that same £10,000 example, and that's before we even talk about interest. Because HMRC doesn't just charge penalties, it charges interest on the unpaid tax itself. And right now, that interest rate is sitting at 8% per year. That is more than triple what it was just a few years ago in early 2022. So on that same £10,000 tax bill, if you were a full year late, you'd be racking up approximately £800 in interest charges on top of all the penalties. We're now looking at over £1,500 extra just from being disorganised or uninformed. And here's the thing that really makes this sting. HMRC has been intentionally lenient for the first few years after this rule came in. They were easing people in. But experts who watch HMRC's enforcement patterns very closely are now saying that leniency is over. HMRC is clamping down, and the doubling of those failure to notify penalties is the evidence. So let's talk about why so many people genuinely don't know about this. The first reason is that this 60-day rule is actually relatively new. Before October 2021, it was a 30-day deadline, and before 2020, the whole system worked completely differently. So if you sold a property a few years ago and you've been speaking to people who sold property back then, the advice you got might already be out of date. The rules changed, the deadlines changed, and not everyone kept up. The second reason is that a huge number of people genuinely believe that if they file their self-assessment tax return and declare the sale on there, that covers everything. It doesn't. The 60-day return and the self-assessment return are two separate obligations. You have to do both. HMRC has confirmed this. If your property completed in, say, May of one year, you cannot just wait until the January self-assessment deadline to sort it. You had until early July of that same year to file the 60-day return. Missing that deadline is a separate failure with separate penalties, even if you then correctly declare it on your self-assessment later on. The third reason people get caught out is the annual capital gains tax allowance. Now, this is a really big one, and this directly explains why HMRC is catching more and more people right now. A few years ago, every individual in the UK had an annual exemption, which meant the first £12,300 of capital gains each year were completely tax-free. So if your gain on a property sale was relatively modest, you might have fallen below that threshold and owed nothing. But HMRC slashed that exemption. In 2023, it went down to £6,000. Then in 2024, it went down again. And now for the 2024 to 2025 tax year and onwards, the annual exempt amount is just £3,000 per person. £3,000, that is a 75% reduction from where it was just a couple of years ago. What this means in practice is that tens of thousands of people who would have previously owed nothing, who would have been completely under the radar, are now over that threshold and technically liable for capital gains tax. And HMRC knows it. This is not a coincidence. The government reduced the exemption partly to raise more revenue and partly because lower exemptions mean more compliance obligations, which means more penalties when people don't comply. It's a very effective trap if you're not paying attention. Now let's get into the situations that catch people most by surprise, because this is where I really want you to pay attention. The first one is inherited property. If a family member passes away and leaves you a property, the starting value for capital gains purposes is usually the value of the property at the date of death, not what the original owner paid for it decades ago. So if your parents bought a house for £30,000 in 1985 and it's now worth £350,000 and you inherit it and then sell it for £360,000 a year later, your capital gain is roughly £10,000. That's the difference between what it was worth when you inherited it and what you sold it for. That is potentially above the £3,000 exemption. That means a capital gains tax bill. And if nobody tells you that, if you just think you've sold an inherited property and put the money in your pocket, you could be sitting on an unpaid tax liability right now with penalties and interest ticking up in the background without you even knowing it. The second situation is properties that were partially your home and partially rented out. This is extremely common with landlords who started off living in a property and then moved out and rented it. The rules around private residence relief are time apportioned. So let's say you owned a property for 10 years. You lived in it for the first 4 years. Then you moved out and rented it for 6 years. When you eventually sell it, you get capital gains relief for the 4 years you lived there, plus the final 9 months of ownership, which HMRC automatically treats as if you were still there. Everything else is potentially chargeable. And a lot of people don't realize this because they think, oh, I used to live there, so it's my main home, so I'm protected. That's not how it works. And here's something that trips up even more people on this specific point. There used to be something called lettings relief, which could take another £40,000 off your taxable gain if you'd rented out a property that was once your main home. But in April 2020, the rules changed massively. Now you can only get lettings relief if you were living in the property at the same time as your tenant. So if you lived in one room and rented out the other rooms, yes, you might still qualify. But if you moved out entirely and then rented the whole thing, lettings relief is completely gone for you. Thousands of landlords who bought properties, lived in them, moved out and rented them, and then eventually sold them are working off advice or assumptions from before April 2020 that are simply no longer correct. The third situation, and this one is massive, is people who have two homes. If you own two properties and you've never made a formal nomination to HMRC about which one is your main residence, you could be in a really difficult position when you come to sell. Because HMRC will look at the facts. Where do you actually spend your time? Where is your post delivered? Where are your kids at school? And if they decide that property B was actually your main home, but you tried to claim relief on property A when you sold it, that could trigger not just a capital gains tax demand, but also penalties for incorrect or misleading reporting. The nomination process exists, it is done in writing to HMRC, and it has to be done within 2 years of acquiring a second property. If you haven't done it and you've owned two properties at some point, this is something you need to look into as a matter of urgency. Now let's talk about how HMRC actually finds out about all of this. Because some people genuinely think that if they just say nothing, HMRC will never know. HMRC has access to land registry data. Every property sale in England and Wales is registered. HMRC can cross-reference land registry records with tax records. It can see who sold what, when, and for how much. And it has been investing significantly in data analytics and systems to flag discrepancies. The days of HMRC being a lumbering, slow organisation that might never notice your sale are long gone. This is an organisation that is being pushed to raise an extra £5.1 billion per year by 2029 through exactly this kind of compliance and enforcement activity. Property is a massive target, and if you sold a property that isn't on your tax record, it is only a matter of when, not if, that gets flagged. When HMRC does come after someone who hasn't declared a gain, the penalties are significantly worse than for someone who filed late. A standard late filing is bad enough, but a failure to notify HMRC of a liability at all, which is what happens when you don't file anything, carries penalties that scale based on your behaviour. If HMRC decides your failure was careless, you could be looking at penalties of up to 30% of the unpaid tax. If they decide it was deliberate, that goes up to 70%. If they decide it was deliberate and you tried to conceal it, it goes to 100%. 100% of the tax owed as a penalty on top of the actual tax and the interest. And the bar for what counts as deliberate is lower than most people think. If HMRC decides you should reasonably have known you had an obligation, that can be enough. So what do you actually do if you think you might have a problem? Or if you want to make sure you're protected going forward? The first thing is, do not ignore it and hope it goes away. It doesn't go away. It gets more expensive with every week that passes. The penalties go up, the interest accrues daily, and the longer you leave it, the worse your position is when HMRC eventually does find you. And they will. The second thing is, if you think you might have a historic sale that you didn't report correctly, you can make a voluntary disclosure to HMRC. Coming forward yourself before HMRC investigates you is treated as a mitigating factor. The penalties are lower, the investigation is typically less intensive. HMRC has a specific disclosure facility for exactly this kind of situation called the Let Property Campaign, which is primarily aimed at landlords, and more general disclosure routes for others. Telling HMRC yourself before they tell you they know is always the better outcome. The third thing is, make sure you understand the 60-day rule for any future property sale. From the moment you complete on the sale of a residential property where you owe capital gains tax, that clock is running. 60 days. You need to have set up your government gateway, created your property account, calculated your gain, and submitted the return and payment within those 60 days. This is not optional. It's not something you can sort later when you do your annual tax return. It is a separate, standalone obligation with its own penalties. Now let's talk about some of the things you can legitimately use to reduce how much capital gains tax you actually owe, because not everything about this picture is doom and gloom. First, you can deduct genuine costs from your gain. The legal fees you paid when you bought the property, the stamp duty you paid at purchase, the estate agent fees and solicitor fees you paid when you sold it, any genuine capital improvements to the property, meaning things that actually added value, like a new extension, a loft conversion, or a completely new kitchen. Not maintenance, not like-for-like repairs, but genuine improvements that enhance the value. All of those can be subtracted from your gain before you calculate what you owe. A lot of people forget to claim these or don't realize they're allowed to, and they end up paying capital gains tax on a bigger number than they need to. Second, if you still qualify for any private residence relief, even partial relief, make sure that's correctly calculated. The time you actually lived in the property plus that final 9 months all comes off your chargeable gain. Done correctly, this can make a significant difference. Third, remember the £3,000 annual exemption. It's small now, but it still exists. And if you're selling a property jointly with a partner, you each get your own £3,000 exemption, so £6,000 between you that's sheltered. Fourth, if you have capital losses from other asset sales in the same tax year, things like shares that went down in value, those losses can be offset against your property gain to reduce the amount you're taxed on. This requires proper record keeping, and losses need to be registered with HMRC, usually through your tax return, but it's a legitimate and often underused way to reduce your liability. Fifth, and this is a slightly more advanced point, if property is jointly owned by a married couple or civil partners, you have some flexibility in how you structure the beneficial ownership before a sale. Legal title is not the only thing HMRC looks at. If the beneficial ownership is genuinely 50-50, you each report 50% of the gain. If it's structured differently and you have the formal documentation to back that up, a declaration of trust, it can be apportioned differently. Married couples can also transfer property between themselves without triggering an immediate capital gains charge, which can be used for planning purposes before a sale. But this needs to be done before the sale completes, not after, and it needs proper documentation. Now let's bring this all back to the big picture, because I want to make sure you leave this video understanding exactly what's happening and why now is the moment to get on top of it. HMRC has been given a political mandate to raise more money from tax compliance. The capital gains tax exemption for individuals has been cut to £3,000, which means hundreds of thousands more people are now in scope for capital gains tax who weren't before. HMRC is using land registry data and sophisticated analytics to identify property sales that haven't been declared. The failure to notify penalties have already doubled in 2 years, and every expert in this space is saying that trend is going to continue. The 60-day reporting deadline is separate from your annual tax return, and most people don't know about it. And the combined cost of late penalties plus interest at 8% per year can add up to a very significant sum very quickly, on top of whatever tax you actually owe. If you have sold a property in recent years, even your family home, even an inherited property, even something that you genuinely thought was tax-free, it is worth sitting down and thinking through whether the 60-day return was correctly filed and whether any capital gains tax was due. If you're not sure, speak to a qualified tax advisor. The cost of a conversation with a professional is nothing compared to the cost of a penalty investigation from HMRC. And if you're planning to